Federal Reserve Chairman Jerome Powell back on Capitol Hill for day 2 of congressional testimony facing the House Financial Services Committee. And we've been hearing a lot about what the Fed chairman has been saying with regards to obviously inflation and how the Fed will respond to what is inflation at paces we have not seen since the early 1980s. Yahoo Finance's Emily McCormick is here to chat about the highlights. And Emily, that hearing is still ongoing right now, but a big word that caught a lot of attention so far is unconditional, is how he described the Fed's approach to wanting to get inflation down.
That's right, Brian. And I think a lot of what we're hearing from Powell, at least in the early goings of this hearing, is similar to what we heard yesterday when he was speaking before the Senate Banking Committee, in that Fed Chair Powell is really trying to drive home this notion that it remains the top priority to bring down inflation, currently at 8.6%. If you look at that CPI print that we just got for the most recent month, and really talking about how imperative it is to really get these price increases under control here. Now, of course, he is trying to thread the needle, as he mentioned yesterday before the Senate Banking Committee. He said that it is not the goal of the Fed to induce a recession in trying to bring these prices under control, but at the same time is trying to take a really tough stance here with his rhetoric and really emphasizing to Congress and to the American public that getting inflation remains the main target right now for the Fed.
Yeah, and it's a really tough tightrope to walk, because for the Fed, at least right now, the options are either you allow inflation to go unkempt and then you end up going into recession, or the Fed has to hike rates too abruptly to get ahead of inflation, and then you go into a Fed-induced recession anyway. So I think that's a big reason why you're seeing a lot of consternation. You look at the bond market. We already saw the bond market show signs of inversion, which has usually preceded a recession historically. But, interesting movement yesterday. I mean, the 10-year yield down double digit in terms of basis points. You don't see movements like that, although Jared Blickery and others have pointed out that some of that might be pinned to commodities movements as well.
That's right, Brian. And we did see that yesterday, WTI crude oil futures did settle at their about 1 month low here, just above $106 per barrel. You could see still holding now actually below that level in intraday trading today. So when we see oil prices moving down, of course, this is largely in response to concerns that we are going to see demand destruction because of these recessionary concerns. If you look inside of the S&P 500, yes, the broader index is up today. It had been up for some of yesterday, then ended slightly lower. But you're seeing this defensive positioning in terms of the S&P 500 sector action. You're seeing things like healthcare, consumer staples outperforming on an intraday basis. The cyclicals like energy, industrials are underperforming. So really it speaks to the fact that investors are getting more defensive, perhaps positioning for that potential for a downturn when it comes to just all the indicators that they're looking at when they're listening to what these Fed speakers have to say.
Well, defensive is kind of a tough situation right now, because we've had people come on the show in the last few days and say there's nowhere to hide right now, right? I mean, people aren't even going in fixed income because the rising rate is causing a lot of repricing. And even when you look at just kind of whether or not the growth stocks are now looking cheap enough to buy, well, now you have some people out there on the street apparently calling Facebook and other big tech names value stocks now. What's going on?
Exactly. So if we take a look here, we do have some news coming out from the FTSE Russell. They're actually due to rebalance the stock benchmarks at the close of trading this week. We're going to see Meta Platforms, the parent company of Facebook, as well as Netflix and PayPal Holdings jump into the Russell 1000 Value Index. Now, when you think about a value stock, you don't necessarily think about these historically tech and growth names. But at the same time, you think about the year-to-date performance of many of these stocks. Take a look at Meta Platforms, take a look at PayPal and Netflix, all down by double-digit percentages. I mean, Netflix still down by nearly 70% for the year to date through intraday trading. Really speaks to the fact here that we're seeing these price-to-book ratios come down. That's really one of the big ratios that we look for that Russell 1000, that value index. But at the same time, I think there has been some skepticism. If you see what analysts have been saying about this move here, it's the question of, can you really call these tech stocks value names in a traditional sense? But at the same time, this move by the FTSE Russell is perhaps saying maybe investors shouldn't be expecting the kinds of growth rates that we saw over the course of the pandemic for a name like Netflix, for a name like Zoom, that saw all this increase in business activity when people were still working from home.